Welcome to today's episode. It's all about business success. So whether you're just starting out or you're already established, I'm going to be talking to one of the UK's top experts on things like how to take the headache out of your business, how to plan your cash flow effectively, and also strategies for scaling sustainably. So today's guest is Heather. Welcome, Heather.
Thank you.
So a little bit of an intro. So you've worked in the US and the UK in operations, finance and IT. You've been an FD since 2003, working in things like real estate, skincare, tech, and most recently with two of the UK's top 20 startups.
That's right.
So let's start with the basics then. What are the key dates to mark in the calendar?
One of the most important things for everyone to remember is what are the dates they need to start planning for paying tax.
Yeah.
So every company is different, and if you're a sole trader, it's really easy. It's the same as your personal tax year. So you need to report at every January 31st to HMRC. You need to make a payment then, and you need to make a payment on July 31st.
And that's the one that always catches people out, isn't it? That payment on account, because it's money that you haven't actually truly had yet.
Well, there's good news and bad news. In the very first year you become a sole trader, you pay no tax for ages, actually for so long it's dangerous. And the very first January 31st, after the April deadline the year before, you report on your first years of profit and you pay all that tax at once. And most people don't remember to save for that. But the double kicker is you also then have to pay an extra 50% on top of that to start paying toward your next year's tax. So you have this huge long period where you pay nothing, and then you get absolutely clobbered in your first tax payment. But then after that, it should be pretty steady as long as your income is steady. And a really important thing to remember is if the year you first reported on was huge, and you know you're not going to do as well the next year, it doesn't even need to be your first year. You can always write to HMRC and say, next year is not going to be so profitable, so don't make me pay so much up front. And they always say yes.
That's a really good tip. I always freak myself out. So I set aside the tax on my whole income rather than my profit. So I'm oversaving, but it does make me feel really tight on a monthly basis. So a bit scared, but I prefer it that way than I've been in some pickles in the past.
Exactly. Depending on how you spend your money, if you're quite profligate or if you're a saver, it's a really good idea to save too much for tax, because there's nothing worse than not being able to pay your tax. It's horrible. It's really important if you have a limited company that you've got very, very different dates to pay tax.
Yes. Yeah.
And again, you can choose whatever financial year you want. Most people like having it be a December year end or a March year end, but it can be anything you want. The really important date is 9 months after your year end, you've got to pay your tax. It's a little bit weird that you don't need to get your corporation tax return in till 12 months afterwards, but you have to pay in 9 months.
Yeah.
So always put that date in your calendar. And actually, one last tip on your year end, if you pick a year end of March, which is what most people do to match the personal tax year, it means your corporation tax is due at Christmas.
Oh, that's not a good time.
And then your personal tax is due a month later. So it's actually a really difficult time. So I always tell people, try not to make your year end March.
A very good tip.
Yes, but your other dates for paying taxes depend if you're VAT registered. It's usually quarterly, and you can, again, pick whatever quarters you want. You just need to tell HMRC. And if you start to employ people, then you've got taxes that are due by the 22nd of every month for payroll taxes.
Perfect. So getting them in the diary. I have a compliance lady who keeps me on a very tight rein, and she even puts dates in my diaries, like when my policies have to be updated.
That's brilliant.
All those things, because they just slip by, don't they?
They do. And if you wait till the last minute on them when they remind you, sometimes it's too late to look for another deal or to decide, do I still want to stay with this or should I look for something else? So that's very clever.
Yeah, she's very good. So what mistakes do you see people make, especially in those early years where we're trying to find our feet?
We were just talking earlier, there's two different types of people, the overly confident and the overly cautious, and they make very different types of mistakes. So I would say point number one is almost everyone forgets to save enough for tax. That is the most common thing in the world. I'd say number two, if you're one of those cautious people, I would say 99% of you charge too little for whatever it is you're selling. You over-service if you're a service business because you want to make people happy. But both of those things create horrible rods for your back. Number one, it's really hard to raise your prices. And number two, if you overservice, people start thinking that's normal. So when you finally go back to treating them normally, because you've got more clients that need your time, you create this kind of crash in service, which people don't like. So those are probably the most common things that really cautious people do. And the things that really overconfident people do, a lot of it has to do with cash. They truly believe it when they say, if I just capture 1% of the market, I'll be fine. Well, it's really, really hard to capture 1% of the market. And you shouldn't plan for sales that you have no realistic expectation of getting in. So don't start signing up leases on an office for a business that's 10 times bigger than you are today. So overcautious people and overconfident people make very different mistakes.
I think I can see it in people's financial planning. Those cautious people tend to be cash hoarders and not necessarily thinking about that medium and long-term investing. And then, well, if it's a very sweeping statement, but those ones who are extra confident probably just have no financial planning. They believe that the big win will come at the end and it's not worth it.
That's right. That's right.
Which is worrying.
It puts a lot of pressure on you, not in the early days, because the future is always so far away, but it can be very painful.
And I know you and I know some of these cyclical entrepreneurs who are boom to bust many times in their working life.
Yeah.
Okay. And then how do you read financial statements?
Oh, I love reading financial statements.
That's why we need you, Heather.
So there are three classic financial statements, and there's one that everyone understands because it's just your cash statement. What money did you get in? What money went out? And almost every business owner can tell you how much money's in their bank account.
Yeah.
So cash flow statements are really easy to read, but the problem is they don't give you any forward look at what your profit is, and it doesn't tell you how much to save for tax. So it's like the most dangerous thing to do. The profit and loss statement, or as the Americans call it, an income statement, is the second most common one, and it's the one that's kind of easiest to understand from a business perspective. You have your revenues, you have your costs, and if it's really good, it also has an accrual for corporation tax. But again, that in and of itself isn't good enough to help you understand how much money you can take out of the business. That is where you have to rely on the balance sheet, and that is the hardest one to understand. And I have a couple of tricks for you if you're going to start to learn your balance sheet. Is whatever accounting package you use, you should create little groups in it of immediate stuff, which is like cash you've got or bills you're waiting for your customers to pay that you know is going to come in soon. But it also includes things you have to pay soon, which is the bills that are waiting to be paid and any upcoming VAT payments that are coming up soon. So you put that in a little group called like current. And your assets and your liabilities can be mushed together. It doesn't matter. But that's kind of your really short-term cash.
And is that sort of your acid test of whether you're going to survive the next few months?
Yes. It is. But it's also a very good handle on how much free cash you have. Because a lot of people also aren't very good at doing things with money that they've got. Anyways, so you put your little group of current...
What do you mean by that? I'm really intrigued because I wonder if it's me.
Well, a lot of people hold on to too much cash. Yeah. And there are so many ways to make money out of cash. So this isn't really relevant in the early stages of your business, unless you've just got some great funding in, and then it's very important. But there are so many places to put your company's money, whether you open an investment account and put it in ETFs, put it in savings accounts. Now, credit card companies are offering savings accounts. Wise, which people used to use just for financial kind of foreign exchange transactions, now has amazing savings accounts. You can make money off your money. And if you don't, you are really losing out.
True. Especially with inflation. I mean, it's not as high as it was, but it's definitely not as low as it has been.
But it also exists all the time.
Yeah.
All the time. So the whole time you're just letting cash sit in a bank account that doesn't earn anything, you're effectively losing money.
And there are companies out there that will move your money around for you. So you just give it to them and they will make sure that your balance is below the 85,000 limit, so you're protected.
And that's something that no one would ever do on their own. It's too much work. Yeah.
Well, I went to a pension conference just before Christmas, and a pension company has 3 full-time members of staff just renegotiating cash rates all the time.
Wow.
So we were back to the balance
back to the balance sheet.
Yes.
So you're essentially breaking it up into 3 bits and not your classic assets and liabilities. You're breaking it up into short-term or current cash. Then your kind of medium to longer term, which is things like your corporation tax payment, because it only happens once a year. Or if you know you're going to get a rent deposit back at sometime in the next year, it's kind of longer term. And then the third bucket is stuff that, I don't know if I can swear on this.
I think you can.
That I just call shit you don't care about. And there's lots of it. There's lots of just kind of accounting stuff that won't affect your day-to-day life.
Yeah.
They're important. They have to be there in the accounts. But why look at them and try to make decisions based on them? So it's a really simplistic little trick, but it helps as you're getting to understand how much money do you have, what can you spend now. One of the most common questions people ask is, can I afford to hire someone? Can I afford to move into that next office?
Yeah.
And only by looking at your balance sheet in that way can you answer the question.
And I'm reasonably new at my own limited company. And I think, well, I made a rule for myself that every Monday I would spend an hour looking at these numbers. Because at the beginning, I didn't really know what I was looking for and it felt like a waste of time. But I think I've now got, well, I suppose I've learnt that language, really. I understand what certain numbers mean because I see a gradual trend. And a habit that I've brought in, man, I don't know if you could improve this or suggest anything else, but so I do my hour on a Monday, and then I do just 15 minutes, half an hour on a Friday to sort of think about, well, actually what happened last week, what's happening next week. But it helps me feel sane, even if it's not achieving a lot.
Yeah. Well, you bring up 2 really good points there. One of them is that your understanding of things progresses as you move on. And so take that simple balance sheet. Once you get to grips with that, 6 months, 9 months later, you start creating more groups because you understand them a bit more and you can make better decisions. So that's a really important point. It's ever evolving. Even my business has been going for 21 years, 22 years. I have probably rejigged my balance sheet and P&L categories at least 10 times.
Do you look at it every day? Are you more
I am a little bit sad in that I probably do 5 minutes every morning.
Yeah, well,
so
that's good.
I love to see what's happened in the night. So I always, just see what's the latest things that have come in. So I do 5 minutes every day, which usually means I only need to spend 10, 15 minutes a week.
Well, that
and
might
10,
be
15 minutes a month
of the time that I'm spending.
Yeah.
Spread it out daily rather than just a big chunk on a Monday.
And also when things aren't right, it gives you that great chance to question it immediately. If you ask someone 2 months later, hey, I got this payment in and it doesn't match something, they've forgotten it. So 5 minutes a day, I think that's...
Okay, I'll try. I will. Not try, I will. And then... what are the most tax efficient ways to take the money out of the business?
Again, great question. And a lot of it depends how much money you're generating. So for most people that are earning, say, personally, £100,000 or less, it's almost a no-brainer that the best thing you can do is to take a small salary. It's about 12 grand and it changes every year. The rest as dividends up to that 100 grand level. And then as much pensions as you can afford to put in makes a massive difference as well. That's great for tax.
And to be specific, it's great for corporation tax, isn't it?
It's brilliant.
Yeah.
It's absolutely brilliant. And also, if you look at the alternative, which is you take money out as dividends, you pay personal tax on it, and then you invest it, you're going to get taxed on that in a different way than if you had put it in your pensions. So it's great for corporation tax savings in the short term and can also be very good for personal tax savings later.
And then what if you're living the high life and 100 grand's not enough? What tactics can you have then?
That's a great question. So if you have to spend a lot of money every year, not that you want to take it out and save it per se, but if you need to spend that much, then I always say to people, whatever you do, if you have to go over the 100 grand, go over it big, because that first 25 grand above it is the worst tax you can pay in the world. So I always say, try not to just tip over from 100 to 110 or 120, go up to 150 if that's what you need to do.
And a tip that my accountant gave me was, if you need to go over it once every 3 years, let's say. So create a regular income, but you forward take out for the following 3.
That's actually very clever, because one of the annoying things, if you think back to the personal tax, those payments on account we were talking about, if you take out a really big chunk this year, thinking the next 2 years you won't be so bad, you won't have to pay a huge payment on account if you know for sure you're not going to take that big amount out next year.
Going back to the making money work for you, let's say you've got money in the business, you look at your forecasts and you don't need some of the money for a certain amount of time. How do you help your clients with things like that?
Well, usually we introduce them to people like you, because you've got to select where the right opportunity for you is. But I'll give you an example. We've been working for a long time and we've built up a very good stash of CASA in the business. And we move a certain amount every week into a trading account. And this last year, we made about £90,000 of passive income from it.
That's amazing.
Even better, I don't have to pay tax on it now because it's not realized gains. It's just sitting there increasing in value. And until I sell it and bring it back into the company, I don't need to pay tax on it. And we actually use that excess money we made this year to decide to make an extra big pension contribution to my husband and I, because it's tax deductible for corporation tax. And I have to tell you, it's hard to make money in business. It feels amazing to make money without you having to put in the time and the graft. Yeah,
that's a very good point. How do I know when I'm going up a gear? Like, is it good to be steady Eddie, or do I want to make those big jumps and plan for them far in advance? And so this is a paragraph rather than a question, but I have this sort of 7-year plan, and I can, if I looked at where I am now and where I need to be in 7 years, it really, really scares me. I've got to make some ginormous jumps. So how far in advance should I be planning those ginormous jumps?
Very few things in business go up in a steady incline. They do tend to have these big step function jumps in them. And when it's either you add a few more staff and then you can take on enough business, you see a big jump up there, or where you finally decide, you know what, I'm going to start pricing my products or services properly, and you do that big leap. There tend to be bigger jumps than lots of incremental small ones. So in terms of how you plan for them, a lot of it depends on if you're a service business, which is only scalable by people, or if you're a technology business, which is scalable by completely different things.
What are they scalable by?
You might change your business model from an annual subscription to a monthly subscription, or vice versa. You can change the terms and conditions. You can have some of your services provided by an AI or something. There's lots of different things you can do, but changing your business model is probably one of the biggest ones.
Usually when you're running your business, you're so in it that you forget to take a step back and think about changing your business model. How do people do that? They find they find a business coach. What do you recommend?
I would say there's about 4 different ways you can do it, unless you're ridiculously disciplined and can do it on your own. One is, you find a trusted advisor, whether it's an accountant, an IFA, or anyone like that. Another one is to find a couple of like-minded people that run their own businesses, and you commit to sitting with each other once a quarter or once a month, and you talk about each other's business. It's really important to get the viewpoint of other people that are sitting in your shoes, because you get lots of advice from people that don't know what they're talking about.
Very true.
It's really good to have a sounding board of people that are similar. And they don't need to be in the same industry, just people that run businesses. And in fact, it's usually better if it's not the same industry, because you get completely new and fresh views of things.
And finally, Heather, I know often your books are very full, but how can people get in touch with you if they'd like to?
Well, I have the best practice manager in the world, Antonia, who loves talking to people.
She's lovely.
Yeah. She loves talking to people of all different types of businesses, different stages, and quite often, if it's not a perfect fit for us, she has a great network of other accountants and people that can be introduced.
If anyone's trying to get in touch with Antonia, what will they do? Go on your Instagram?
You can totally contact her on Instagram. It's @thebossuk, or send an email to info@asktheboss.co.uk, and Antonia will set up a meeting.
Thank you.